So there's a lot to go over today. The market obviously had a pretty big end to the week with option expiration playing a heavy hand in that. Now, obviously, this week we're going to be seeing the market trade post opex, and so a lot of that gamma and pinning effect we were seeing in the market between that 6,600 and 6,650 level are going to dissipate. And so even on Friday with opex, you could see that kind of getting pinned at some of these more important levels, and then the last hour or so we just really kind of moved up into the close. And so again, a lot of this pinning effect should really dissipate once we pass opex, but I think it's important to really also pay attention to some of the technical signals we're getting here. And we're getting a lot of different signals from many different parts of the market, whether it be technical volatility, but it's worth taking a quick look at some of those things. So I like to use Bollinger Bands in conjunction with the RSI. And so what that means is that just because we're over the Bollinger Band doesn't necessarily mean we're overbought in my book. And just like if we're above 70 on an RSI, it doesn't necessarily mean we're overbought in my book either. What I like to look at is the combination of the RSI and the Bollinger Band. So when we see the RSI go above 70 like we are right now, when we see the price action get up to or above that upper Bollinger Band, it really kind of signals to me that the market is overextended and that we need to go through a period of at least sideways consolidation where we're consolidating through time, or we need to see some form of a pullback in the marketplace to kind of reset things and cool them off. And so this has been a fairly good tool that I've used over time. I mean, here's one such example more recently back in on July 3rd of this year, and you can also use it obviously on the downside as well. But again, you can see the same thing is currently existing in the NASDAQ, with the NASDAQ RSI above 73 and in this case clearly closing above the upper Bollinger Band. So it looks to me like when we look at the market just from a purely technical standpoint, it looks like we're in an overbought position and we're due for at least some sort of cooling period or at least a sideways consolidation. But when we start looking at other things, the picture becomes a little bit more murky and a little bit more concerning to me. One reason why is if we look at the number of stocks above their 200-day moving average on the S&P 500, you can clearly see that this has been moving lower really since peaking at the end of August. And when we combine this with the chart of the S&P 500, what you see is that there's this divergence that's forming in the market. And typically when these divergences tend to form, they tend to occur during periods when we're going to start maybe seeing some volatility pick up in the marketplace. So here was such occurrence, and here we're going into 2018. Here you can see going into the COVID crash, we had that big move up in stocks and the divergence in breadth. Even more recently, we had a market moving up with the divergence of breadth moving down, and seeing the same thing really taking place right at this moment in time. And so I think that this is an important signal that we need to be aware of. The other thing is really coming from the volatility complex, and what we're seeing, which really kind of stands out to me at this point, forgetting about things like implied correlations and such. Implied correlations right now are really fair, are really fine with where they are. Also, what we're seeing right now is that realized volatility levels are getting very low. We can see on the 9-day, if we just go through different levels of realized volatility, 9 days realized vol is as my dog comes and pays us a visit. 9-day realized volatility right now is around 4.7. And you can see that historically this is a very low reading on the chart. And typically when we get to levels of this nature, we tend to see them reverse and go the other way. So this is a really important kind of distinction right now when we're looking at the realized volatility level. When we look at the 21-day kind, that's volatility levels aren't nearly as extended. And when we look at the 3-month volatility levels, you can also see that this is also at a very, very low level. Historically, we don't really get to levels this low, and you can see that July of 24 was one such example. Of course, we remember what happened during that period of time. September of 21, we remember we went through a period of volatility going into the end of the year that year. Then we had January of 2020. Then we have this one here, October of 2018. And then you also have January of 2018. And these all led to really very volatile periods in the marketplace. And this doesn't really give me the feeling that this is going to be an exception. And so when we consider all these different things from a technical standpoint, from a breadth standpoint, and also from a volatility standpoint, it gives me reason to really cautious here with the market and to think that this is in a pretty precarious spot. The other thing that I'm not really loving right now is the fact that we've seen reserve balances come down to that 3 trillion mark. Again, we were talking about this now for a couple weeks. Reserve balances were due to come down as the TGA was due to rise, and so now that's pretty much played out as expected. What I like to do also when I'm looking at liquidity is I like to take reserve balances and add it to SOFR turnover, because a lot of the money that was in the reverse repo facility in a way has just turned over into SOFR and other forms of general collateral. And when we kind of take those two together, you get also a feeling of how much liquidity and collateral may be in the marketplace. And you can even see there that this number has been coming down the last couple of weeks. And then if we want to really take it one step further, we can add in all of the different type of collateral, meaning tri-party collateral as well. And when you add that in, you can see that even that number is starting to come down. So from a collateral standpoint, it also looks like liquidity is starting to maybe become a little bit more of an issue for the marketplace. Also, the one thing that I've noticed is that the average repo rate, the average funding market rate, has also climbed. The 10-day moving average has actually risen to a point where now trading about 12 basis points above the effective funds rate. And that's a really important thing to note too, because that's telling us that liquidity in the overnight funding market is getting very tight. Also this week we got an update in terms of repo activity, equity repo activity, and that also has been generally coming down the last couple of weeks. Again, it's a very hard number to track, a very hard number to predict, and it's more of a backward looking thing. But again, it gives us a sense of the impacts of higher funding rates are potentially having there. The second to last thing I wanted to take a look at, this is basically taking the S&P 500 market cap and dividing it by reserve balances, which a lot of people think about as just Fed liquidity. And you can see that that number has now eclipsed the previous high in September of 2019 when it was at 18. Now we're at 18.4. So again, from a perspective of liquidity, the market seems really stretched on a liquidity basis when we think about it versus the size of reserves. And then finally, when we look at dealer balances, this is going to be a very important topic as well, because now that the TGA is refilled and we're seeing reserve balances coming down, we're going to start seeing a lot of this issuance that the Treasury is doing start showing up on balance sheets of dealers. And if the balance sheets of dealers start getting filled with all of this Treasury that's being issued, and you start seeing this volume really begin to tick higher, that's going to be less liquidity that's also available to equities, and that could be another problem going forward. And so when you combine all these different signals, all these different pieces, it really kind of gives me this sense that the market right now is in a pretty treacherous and treacherous position, meaning that it appears that liquidity is really thinning. There are certainly signs of thinner liquidity levels, not as ample as there had been. The market we know is overbought. We know volatility levels are extremely low. And, those things together are enough to make you think that maybe things aren't as sound as they would appear or we hear on the media, because those are really important foundations and fundamentals that drive the market overall. And, just one last thing before we go, please remember to subscribe to this channel, like this video, share it with your friends, and we'll see you again during the week. Bye.